This is the lowest our official cash rate has been in more than 2 years, while our economy has been under arrest by Adrian Orr. How much more rate relief should we really expect? How long do you think it will take this cut to transfer through to the real economy? Or perhaps has that work already been done?
Yeah, that's such an interesting question, because one of the challenges that the Reserve Bank has had is that they've cut the OCR pretty aggressively. The reality is the forward market has already priced the easings that most people are expecting. So it's not clear that even if they cut another 50 basis points, that mortgage rates will fall very much.
Comfy. Today, the Monetary Policy Committee reduced the official cash rate by 50 basis points. That takes it to 3.75% and reflects the fact that inflation continues to abate.
The crowd didn't go wild because we all knew this was coming. Banks have already slashed real interest rates in the lead up, but the governor did signal more cuts are to come.
It doesn't stop there. We have our projection of the OCR being around 3% by year end.
The central bank's forecasts are finally matching the market, which predicted larger cuts would be required early this year. This shows just how much its rate path changed from November to February. In total, the bank's shaved off 40 basis points from the OCR between this year and next. We're on our way to talk with rates analyst Sean Keane after his own meeting with the Reserve Bank. He's one of many in markets that was ahead of the central bank's moves. So here's what he thinks they may do next and the impact it will or won't have on our economy. Sean, Happy New Year, good to see you.
You too, Madison.
Did you have a good break?
It was very fast, thanks to Donald Trump.
We will blame DJT. Let's talk about the cut, the most recent cut first, the 50 basis points from the Reserve Bank. Fully priced in, everyone including yourself expected it. Give me the thesis as to why it was so clearly required.
It was required because the economy has been slowing for some time, and the RBNZ talk about it in terms of the output gap. And the output gap is effectively the performance of the economy versus the potential performance of the economy. So we've got an economy that's not using all of its resources. There's a lot of spare capacity. And the way that you consume that spare capacity is by stimulating the economy, usually by lowering interest rates. So the RBNZ is quite appropriately bringing the cost of funding down with the objective of stimulating activity and closing that output gap.
The market, including yourself, was calling for this for far longer than the Reserve Bank was willing to act upon it. It's quite cute that it's now matching the market in its OCR rate path. What took it so long?
I mean, to be fair to the Reserve Bank, we all criticise the Reserve Bank often and regularly, but the Reserve Bank were dealing with a set of data that was drastically revised. So both at the end of 2023 and at the end of 24, Statistics New Zealand substantially revised the GDP numbers. Now, the RBNZ are careful not to criticise stats. They're dealing with limited resources and doing as good a job as they can, but the reality is, these are probably the largest GDP revisions of any advanced economy in the world that we've seen consecutively on 2 years. And so if we go back to the end of 2024, the Reserve Bank was holding, 23, the Reserve Bank was holding quite a hawkish position versus the market. So the Reserve Bank wasn't willing to cut and the market was starting to push for it. The reason for that was that the GDP numbers were suggesting there was strength in the economy. Now, subsequently, the revision showed that strength wasn't there. So the market was looking at other data. The Reserve Bank was hesitant, I think, to react to the other data until the official data, the big numbers, the GDP type numbers, confirmed it. Now, the change that we've seen in the Reserve Bank from last August in particular is if you like, an acceptance that they can't just rely on these core numbers that traditionally have been the guideposts for central banks around the world. So usually it's CPI, employment and GDP. GDP is important. The data in New Zealand is of such questionable quality now that the Reserve Bank are looking at lots of other indicators. So the BNZ PMI, the BNZ PSI, the ANZ truckometer, some of the building consent data, the arrivals data. These are the things, the real-time things that the bank is looking at. Now, as a market person, we've been looking at this stuff for years, and it's what the hedge funds do and the asset managers around the world. And it's why asset markets move well ahead of a central bank. By the time a central bank is adjusting interest rates, the market is already there. The market's way ahead of them. What the Reserve Bank are doing now is adopting some market practice. And that market practice means that it's quite likely the Reserve Bank will be much more active going forward because they're getting data much faster.
What has also been active is banks and lowering real rates. You've told me, I think late last year, probably when we spoke last, Sean, that transfer from the official cash rate, the wholesale cost of borrowing, through to real rates like mortgages and business loans has shortened through this sort of rates crazy cycle roller coaster that we've been on. How long do you think it will take this cut to transfer through to the real economy? Or perhaps has that work already been done?
Yeah, that's such an interesting question, because one of the challenges that the Reserve Bank has had is that they've cut the OCR pretty aggressively. So the last 3 easings have been 50-50-50, and they did a 25 basis point cut before that. The 2-year fixed rate mortgage had come down by about 125 basis points. The floating rate mortgage had only fallen by half of that, by about 60 basis points.
Isn't floating supposed to move more?
Not necessarily. The floating rate mortgage reflects the cash rate as it is today. The 2-year fixed mortgage reflects the market forward price, so where the market thinks interest rates are going to go.
Right, which has been projecting lower.
And it's been projecting lower. So the challenge for the Reserve Bank is that they've pushed this stimulus into the economy and to mortgage borrowers. But in fact, mortgage borrowers, about half of them who've taken out floating rate mortgages, have only been benefiting from half of the rate cut. So they've only been getting 60 basis points off their mortgage rather than the 125. So the challenge for the Reserve Bank is, when do people move from floating rates to fixed rates? And then they take better advantage. Now, people are logically looking at it and saying, it's likely that the Reserve Bank are going to cut rates further. Therefore, I don't want to fix my mortgage. So I'll stay on floating. And then when they cut, I'll be very clever and I'll fix. The reality is the forward market has already priced the easings that most people are expecting. So it's not clear that even if they cut another 50 basis points, that mortgage rates will fall very much.
Because typically when the Reserve Bank comes out with a cut, it then signals to the market to respond. But you're telling us that the response has already happened. So what leverage does the Reserve Bank have with this cut, let alone any others to come, on their way to 3.1, if that is where they find a floor?
Yeah, well, so I mean, the Reserve Bank is, the objective of the rate cut isn't necessarily just to boost the housing market, it's to provide some relief for households. But there's myriad other ways that it's looking to stimulate the economy and close that output gap, one of which is via a lower currency. If you take our interest rate differential negative or down, presumably the currency will fall. That's better for our exporters. It reduces our dependence on imports. So that's a positive. So far as the households go, though, it's important, I think, that people do switch away from floating into fixed to utilise some of that additional stimulus that's there. And so you heard them a little bit yesterday. Karen Silk, the Assistant Governor, made some fairly oblique comments in the press conference about expectations for where interest rates might go. And what she was saying was mortgage rates may not fall that much more. Now, one of the things the Governor highlighted was that lending levels or lending volumes are relatively low. The banks need to lend money. His view was that, well, perhaps if they want to maintain their growth rates, they compress their margins.
Do you really think they're going to do that? Come on.
It will be fantastic if it happens, but historically they tend to sit around 200 basis points net interest margin to 240.
I do want to talk to you about that lower NZD and what that may look like as an inflation potential risk. But on the cut we just had, that was the 200th cut in the history of the Reserve Bank. You've been here for many of those, if not all, Sean. And I mean that in the biggest compliment of a way, because you are the complete expert on the stuff. But talk to me about the history of hikes and cuts. How big is a 50, historically speaking? And is the transfer of a cut versus a hike felt more keenly in one direction than the other, looking at that history?
Yeah. So yesterday was the 200th meeting to set the OCR. So they started this in March 1999. So Don Brash, who was governor then, and I was actively watching that, he set it at 4.5%. Now previously we had an older system where basically monetary policy was was set and conveyed via additions or subtractions of cash to the short-dated cash system. So you made money scarce or you made money abundant, and interest rates went up and down on their own. This was a change where we target a specific rate, and it's the standard way that the world does it now, and it's a much better approach. Now, the Reserve Bank has had 200 meetings. Of those, 105 of them have been monetary policy statements. So the RBNZ is unusual in that we have a monetary policy statement and then we have some sort of interim review. We used to call them monetary policy reviews. They're now called official cash rate reviews. And effectively what it is one is a very deep dive into the whole economy, and the other one is a quick look at what's changed since the last time we did it. So we've had 200 meetings, 105 deep dives, and then we've had 93 reviews, and then we've had 2 emergency actions. So one after 9/11, where they rapidly cut interest rates. So this is outside of the regular dates. And then in the pandemic, where they did an emergency rate cut as well. So emergency rate cuts are very rare. They're as rare
So they
as
should be.
So they should be, absolutely. Now, when the bank changes the OCR, it tends to set off in a direction, and it maintains that direction for a while. So the RBNZ is slightly unusual in the 26-year history of the OCR. They've never hiked and cut, or cut and hiked in the same year. So they've never reversed themselves in the same calendar year. Most other central banks have done that. Policy error, they get it wrong. The Reserve Bank hasn't. And there might be some good luck rather than good judgment in that, but nevertheless, they haven't done that. What they tend to do is when they set the OCR in March 99, they sat and did nothing for 6 meetings. Then they decided interest rates were too low. So over the next 6 meetings, they just pushed interest rates up. They raised them about 200 basis points. And then they sat for 5 meetings and did nothing, and then they took them down again. And so over the 26 years of monetary policy in New Zealand, we've had 26 cycles. It's coincidental. It's not annual. Sometimes there's 2 cycles in a year. They hike and then they hold, but there's 26 cycles. They've raised rates 13% cumulatively. So if you raise 25 basis points, 25 basis points, 25 to 1%, that's one. They've done it a total of 13%. Including yesterday, they've cut rates 13.75%.
So net, we're back where we started.
We're not far off. So what that tells you is that the average or neutral rate for New Zealand is somewhere between 4 and 4.5. As of today, we're at 3.75. The governor is suggesting that by year end we'll be at 3%. So everything is a big cycle over time. Now, in answer to your question about the way they move, the RBNZ is the same as all central banks in that the way that they operate is that they tend to move up in smaller increments. So economic growth picks up, activity increases, the Reserve Bank looks at the state of the economy and says, we need to slow things down a little bit, so they tweak rates higher, up 25, up 25, up 25.
More cautious.
When there's a down cycle, it's often triggered by an event. 9/11, the pandemic, the Asia crisis, whatever it is, it requires emergency action, and then they cut by bigger amounts. So over the 26 years, the average rate hike has been 33 basis points. The average rate cut has been 46 basis points. So there's an asymmetry to this. They cut more aggressively than they hike. Now, about 2/3 of the time, they do nothing. They just sit and they watch and nothing happens. But when they're active, about 60% of the time they're hiking in 25s, well, just over that. About 30% of the time they hike or cut in 50 basis point moves. And then the balance is more than that. So we've actually had 2 moves of 150 basis points, which was after 9/11 when they cut really aggressively. And in fact, I think they took rates down 550 basis points in 6 meetings. So they can be very, very aggressive when they need to, but it's usually downwardly. They're not so aggressive moving rates up.
And to your earlier point about once they set their trajectory for the year, whether it's up or down, they tend to stick with it, right? So now they've started 2025 with a cut. They've said in their OCR path that they see that finding a floor around 3.10%. Do you buy that? What's your thinking of where this goes and to what degree and to what pace they lower from here and where it ends, given everything they've done in history?
Yeah, I mean, I think their outlook and their rate path is entirely reasonable. And it's where the financial market already was. You know, the assumption is they need to get down towards 3. Now, neutral, this great nebulous concept of where neutral is. The governor said yesterday we're at 3.75. That's the top end of neutral, is what he said. I think the chief economist might have said he thinks it's somewhere around 3 on the downside. It's somewhere in the range. The real question for the bank and for the market is, do we need to be below neutral, or can we get to neutral and that's enough? If they're successful in closing the output gap and economic activity picks up, if we can reverse the population, the rate of growth that's been slowing in New Zealand, that will help them stabilise above 3. If GDP can pick back up, if tourism can pick back up, and if global trade, the Trump factor, doesn't interrupt activity, then 3 might be the low. But if these things don't recover or they get worse, and Adrian spent a lot of yesterday warning about the geo-economic threat, if that goes the wrong way, then it's likely that they'll have to take rates even lower. But for now, I think it's entirely reasonable.
Well, on that point, tariffs can be inflationary. Lower NZD, you've already pointed out, can be inflationary. More economic growth and more spending, which we absolutely do need in this sort of depressed economy, but also inflationary. If we do get to that sort of floor of 3, right, how much headroom does that leave the Reserve Bank with if they need to hike to buffer against some inflationary upside risk, or vice versa if the economy needs more help?
Yeah, I mean, the 3% is on the low side of history. So we just talked about that being, so the range of 4.5 is probably in the midpoint of where they are. If inflation does start to pick up, well, they've got plenty of room to move back towards 5. That's no problem at all. They can do that easily, and they would do it slowly. But again, the market will be pricing ahead of them. So market interest rates would have moved, swap rates would have moved, mortgage rates would have moved. The bigger risk is the downside shock. An event, something happens, there's a fracture in global markets. I mean, equity markets are elevated. If they were to correct for whatever reason, that would get a response probably from the major central banks around the world, and it might have an impact on economic activity, which would flow through to us. So the Reserve Bank in the monetary policy statement yesterday had a really good piece, actually. One of their breakout boxes was on the impact of tariffs and how it might affect the economy in different scenarios. So they're thinking carefully about this, but they don't know any more than we don't know. But it's very likely that most of the people in the White House don't know either. One man knows what's going to happen.
Well, given that one man took up so much of your summer, we may as well talk about it, right? What's your take on tariffs? How does this play out globally and for New Zealand, but more the global macro story?
Yeah, I mean, there are 101 different arguments about tariffs, and those who really believe in them strongly, and those who don't can't understand why anybody would ever think that a tariff could be either a source of revenue or a source of economic growth. My view is we take what we're given in terms of the policy and then try and interpret what we think will come out of that. I'm skeptical that they're going to raise the numbers that they're talking about raising. I'm skeptical also that the United States will be able to impose these tariffs without doing itself harm in other areas, either reciprocal tariffs or people diverting businesses in different ways. The objective, of course, of the United States or of the Trump White House is to create a narrative that suggests that they're going to raise enough in tariffs over 10 years, and it's the 10-year horizon that they're most focused on, that at the 10-year mark, the CBO, which is the adjudicator of the budget, the CBO can look at the number and say, yeah, that's a reasonable number, and we can identify that we're either reducing the deficit or that we're moving back towards some sort of balanced budget. Now, they don't need to actually deliver those numbers, they just need to be able to demonstrate that these numbers are in our projections and we've tested them. So if you can get increased tariffs and you can argue that GDP is going to be stronger, GDP will generate more taxation, and that because the economy is stronger and the tariffs are lowering some costs while increasing others, the Fed hopefully can bring rates down, that brings your cost of financing down, and the deficit moves towards a better balance. So you can see the argument, the question is can they execute? And I think it's a brave assumption that they're going to actually hit all their goals on this.
Bottom line, we can't control any of this.
No.
We are a price taker as a country, certainly not a price maker in the global market. What does that mean for our 2%? Like, should we just give it up at this point because there's so much out of our control and our ability to achieve reaching it?
I think New Zealand's always, I think Bill English once described us as a cork, bouncing on the waves, and he was talking about our currency at that time. And the reality is that is the case. But we've also got some fundamental advantages in New Zealand in that we're not on the radar, first of all. We're not on Trump's hit list. He probably doesn't have much.
I don't know, the Cook Islands thing may have put us on his hit list.
Well, maybe that's a concern. But the reality is that we're peripheral to the United States. We run a trade position with them that's so immaterial that if it makes it to the Oval Office, there's a lot of other things on ahead of us. We have the ability to trade with both the United States, Australia, and with China for the time being. If we can preserve that in some way, we will probably end up in a better position than many other nations. The test will be if we're forced to choose. We've walked this narrow path, as the RBA governors always fond of talking about, a narrow path. We've walked it for 40 years, and we've been pretty good at doing it, and if we can keep doing that, then great. If we're forced to choose, that will be a difficult choice for us.
Long may the good times last then.
Yeah, that was a very sobering finich, wasn't it?
It was. Do you have something more optimistic and positive to tack on to the end? You're welcome to.
Yeah, what I'd also add is that, we've also got the advantage that, and we forget this, is that most of the world is not like New Zealand. There are 20 or 30 countries in the world that have rule of law, freedom of movement, freedom of capital, fair treatment of foreign investment, where foreigners are treated exactly as New Zealanders are. And the group that New Zealand is part of is exceptionally rare, and it's probably less than 10% of the global population. And so we're a special place. Even though we have lots of disadvantages, we're a special place. We can attract investment if we position ourselves in the right way, because the world is closing down and it's far less welcoming to people and capital than it was, unless you're forced to do that. New Zealand is fairly rare on that, but we need obviously to enhance our offering, which hopefully is what the government's thinking about doing now with some of the initiatives.
I apologise for making this seem negative, but isn't that then an issue for New Zealand? Because we're ascribing to this global world order that no longer exists. We're in the last remaining 10%. 90% doesn't care about it anymore, except for us, and we're holding on to hope of something that no longer exists.
The 90%, 10% is much more about, if you like, 90% of the world is either non-democratic or it's a non-functioning economy. Failed states. Most of Africa is uninvestable. Most of Latin America is uninvestable. China is not the market that we thought it was going to be. India is far too complex for most foreigners to navigate. So when you look at where you can deploy capital around the world, New Zealand's actually quite welcoming. Now, if you're getting a fracturing or into blocks, particularly the fracturing between Europe and the United States, then that provides some potential for New Zealand to position itself as a more welcome home for some of that capital. It's not easy, and it will take time, and one of the things we lack is scale. If you're a $1 billion fund manager, what do you invest in for $1 billion?
The entire country?
Well,
Here it's yours.
there are plenty of things that we need to do, but the initiatives I think have been partly capital constrained, but maybe the ambition isn't there as well. But this is a moment of opportunity, and things change when they have to change. So it's these moments in time. So the New Zealand economy that people talk about in the 80s as being this amazing, fast-growing, innovative economy, Rogernomics and reform, well, that happened because Great Britain joined the EU in 1973, and we sent almost all of our exports to the United Kingdom and Ireland, and suddenly that market had gone. So we spent 10 years figuring out who we were and where we'd send our product, and we discovered Asia was on our doorstep. That was the genesis of that reform. Now, something may break again soon, and we've got to be ready to react.
I agree, New Zealand needs its ambition back.
Yes.
Good positive place to end.
Well
Thanks
said.
so much for your time, Sean. Appreciate
Thanks,
it
Madison.
always. Thanks for watching Markets with Madison. If you enjoyed this interview, please hit the like and subscribe buttons below. I do all of the research for these episodes myself, so your support means a lot. I always love to hear your feedback and ideas, so please drop any thoughts in the comments below. Now go put your money to work.